Good morning, everyone. I'm Greg Faranello, head of U.S. rates for Amerivet Securities, and welcome to Monday Minutes. Brief look back to last week. A big thank you to Fox Business, Maria Bartiromo, Dagan McDowell for hosting us again on Tuesday to really talk about 10-year interest rates in general and also the fiscal liquidity package that's being debated now in Washington. Thank you so much for including us in this journey along the way. Very difficult year. If we go back to the prior Friday with the employment number better than expected, we had 10-year notes trading around 50 to 55 basis points. The real story last week was the sell-off in the U.S. government market, in particular on the long end of the curve. And as we discussed with Fox Business, there was a ton of Treasury supply in the marketplace last week. There's been a great deal of supply, obviously, around the need for fiscal stimulus to fight coronavirus. So Treasury supply up dramatically. We've talked about that 2.7 trillion deficit, 3.7 trillion projected. A lot of that supply has been on the short end of the curve, T-bills, cash management bills. There is still going to be more of that, but what we've seen heading into last week's auctions is a shift further out the curve with increases in 10-year supply, increases in 30-year supply, and that'll be followed this week, midweek on Wednesday, when we get more supply in the form of 20-year supply, 25 billion. The 20-year part of the curve has been generally very well received, but keep in mind the supply that is hitting this marketplace on a consistent basis is very dramatic. The need for concession in the market, given rate levels, is clear. Coming out of Friday with the better than expected employment number, we recommended to clients that they take short-term bearish positions either in the form of yield curve or with regard to outright level. Now, if you go back historically, if you look at yield curve levels relative to Treasury supply, the correlation is very limited. So in other words, Treasury supply in general doesn't really affect the true nature of yield curve shape, which in general is more influenced by economic conditions and obviously central bank policy. But short term, though, within a window of a week, we did see a dramatic sell-off in nominal yields, roughly 20 basis points, 50 to 70 in 10-year. A lot of questions to start the week. We've had a little bit of a rally back with 10 years nudging inside of 70 basis points this morning. But as we said in our weekly piece, we do feel the market should remain vigilant here with regard to the magnitude of the sell-off, but we think it's too early to make a demonstrative statement here as to whether or not this is something bigger. So short term, we pared back our bearish bets in the marketplace as we now focus on not only the 20-year supply on Wednesday, but we also get the Fed minutes. And more specifically to the Fed minutes, we've talked extensively about the Fed's mandate, employment, and inflation. There's been a lot of talk about inflation. If you go back to the last meeting, Powell said explicitly that the Fed now has re-engaged their discussions about their policy review, which has really been occurring over the course of the last year. They've been traveling around the country. They've talked a lot about this. And the policy review was due in June, but given the pandemic, the Fed has pushed that back. So he did say specifically that they've reignited those discussions. He also said that any changes to the policy review, any announcement to those changes would likely come after the policy review was concluded, which he said would be in the near term. So we don't necessarily know what near term means, but the reality is, too, when we drill down even more specifically, what the chairman said is the Fed has already been acting out some of the anticipated policy changes to come into play, specifically around inflation, letting inflation potentially run above its 2% mandate. If you look at inflation expectations now, we're very close to where we were pre-pandemic. That's being reflected in real yield. So from a market perspective, the reality is what will likely come out of the Fed minutes on Wednesday is more discussion over changes to the Fed's dual mandate. But keep in mind, those changes are, at this point, I think, largely expected. We will be combing through the minutes just like everyone else. But like I said, when you look at inflation expectations, to a large extent, this is already priced into the marketplace. More explicitly this week in terms of economic data, we get more housing data, we get another claims number, we get European PMIs, and also House Speaker Pelosi calling back the House with regard to a discussion around the Postal Service. If you listen to the president's words over the weekend, and we talked about this in our Fox segment, we do think the best thing here for the American people, for both sides to come together, get a true congressional deal done. If you listen to the president's words over the weekend, he's open to renegotiating, But both sides need to give here on things that they want if we're going to get a proper deal done. And as we've said all along, and we will remain consistent with that, we still think there's hope for a proper congressional deal to get done led by the president. I'm Greg Faranello, and this is Monday Minutes.